So good morning, everyone, and thank you for joining us for SBB University. I am your moderator, as Michelle mentioned, also the publisher of Seniors Blue Book, which is a free resource guide right here in Lee and Collier County. You can pick up one at the Healthy Life Center right there at Coconut Point, or the one over in Cape Coral. We also are in the pharmacy area of every CVS and Walgreens, including Target. And Millennium Physician Group, your local hospitals, and a ton of different senior centers and areas like that. You can also get a copy by calling us at 239-776-7353. Thank you again for tuning in today. Any questions that you have, please put them in the chat. Today, we're going to be talking about ways to pay for long-term care and being proactive versus reactive when it comes to planning for your aging process. So we have a wonderful group of dynamic panelists joining us today. I am honored to have all of them as my partners with Seniors Blue Book. We'll start over on my left, which would be Miss Gerry Harris, who has a ton of longevity in the industry and is over at Cypress Cove. Good morning. How are you?
Great. Thank you for having me, Amanda.
Absolutely.
It's a privilege to be here with you all.
Do you want to tell us a little bit about yourself and how long you've been with the organization?
Sure. I'm with Cypress Cove, as you mentioned, which is a life plan community, also known as a continuing care retirement community, a CCRC, and I am the Director of Sales and Marketing, and I have been here 11 years this month. Love it here. It's a wonderful community. We have independent, we have assisted living, skilled nursing, memory care, rehab, home health. So we have the full continuum of care here at Cypress Cove, with apartments and villas for independent living.
Fantastic. Thank you, Gerry. All right. And joining us today as one of our new partners over at the Dorcey Law Firm, we have Brian Bronsther. How are you this morning?
I'm good, thank you.
The trick on how to pronounce your name just got me, didn't it?
Yes, it did, but that's all right. I've been known, my childhood nickname was Monster, so that's fine. That was a long time ago. But I'm Brian Bronsther. I'm senior counsel with the Dorcey Law Firm. We're estate planning, elder law, business planning, estate and probate, and asset protection law firm. I've been with the firm a little over 2 years. I'm a transplant from upstate New York, the Albany area, and I've been practicing law for about 36 years.
Wow, fantastic. Well, we're very excited to have you on the panel today and partner with a new partner, Seniors Blue Book. So thank you so much for joining us. All right. And Miss Danielle Gates over at D. Gates Wealth Management. How are you this morning?
I'm good. Thank you for having me.
Absolutely. Tell us a little bit about yourself.
Well, I'm a certified financial planner over at D. Gates Wealth Service Financial Planning Firm. We help people with all aspects of their financial life. And as a financial planner, we look at your goals and match investments or match solutions to fulfill those goals with the least amount of risk, highest probability of achieving those goals.
Perfect. And last but certainly not least, we have Mr. Mark Ary, who's joining us from Trust Mortgages. How are you this morning? I got you on mute. There he is. Good morning, Mark. Uh-oh. Yep, you're not working there, Mark. I'll have to get you figured out. All right, so we'll go ahead and start the discussion and come back around when Mark gets his volume working. And sorry about that, guys. All right, so let's start up with Gerry. I think the question that a lot of people ask is, when they're looking at these continuing care retirement communities, they don't realize that there are financial and health assessments that they have to go through. So tell us exactly what a CCRC is, because people think it's a buy-in, but it's not necessarily a buy-in, and why you have these stringent requirements.
Sure. There is an entrance fee, especially, in the CCRC arena. So you do come in, and there's an entrance fee and a monthly a service fee, and there are multiple different contracts that you can be covered under. But this is certainly a way of being proactive insofar as your health needs in the future, because to your point, you do have to come in being healthy to be covered under one of the contracts, the life care contracts themselves. So there is a health assessment to ensure that you are actually able to live independently, even if you're a couple, because this is an insurance product. We're governed by the Office of Insurance Regulation in the state of Florida. So we're covering you actually for almost like the ultimate long-term care insurance, although you don't lose your benefits if you do have long-term care insurance. So there is a financial as well as a health assessment that you go through to come in. So you don't want to wait until something happens and you go, now I'm ready to make this move, because you may not make it through the health assessment itself. So what we do is we just simply get records, and then you have a conversation with someone here, and our physician here signs off on it. So you don't have to be physical.
Yeah, and looking at these retirement options, and the reason we definitely have a continuing care retirement community on this particular panel is because you do have to be proactive versus reactive. If you wait until you're in a healthcare crisis situation, you may not qualify for a community like a CCRC. And also there are tax benefits. So talk to us a little bit about some of the tax benefits of moving into a community such as yours.
There are tax advantages to moving into a life plan community. A portion of your entrance fee, depending on the plan, if it's refundable or non-refundable, a large portion of it under the life care plan, for example, it's over $100,000 on a one-time basis for a couple coming in on the life care plan, can be deducted as future medical expenses as you're being required to take out your distributions and all. And ongoing, and we send a letter out at the end of each year telling you what you can deduct, but ongoing year after year that you're here, there's also a tax benefit in that it's approximately $22,000 right now for a couple, a little bit less for a single person, again, for future medical expenses. So there are, tax advantages to living in a life plan community, definitely.
Wonderful. Thank you, Gerry. And I think I heard Mark make a little peep. Mark, are you there? Oh, no.
Yeah.
I thought I did. All right. So I'm going to come back around and ask a few more questions of you as well, Gerry, but we'll move on to Brian. Brian, as far as pre-planning goes, what would you say is one of the single most important documents that you need to have in place when you're getting ready to plan for retirement? We'll start with that because I think it's an important question that a lot of folks need to hear.
I would say it's the durable power of attorney.
Mm-hmm.
The durable power of attorney is a document that appoints an agent to act on your behalf. Here in Florida, we use a comprehensive durable power of attorney that literally allows the individual to step into your shoes and handle all and every act that you could on your own.
Right.
In Florida, it's effective immediately. And so we typically have someone appointed as a primary agent and then as a secondary agent in the event the primary is unable to act in that manner.
And when because a lot of our folks that are here are either transplants moving from another state, or they are, relocating back and forth as snowbirds. When would you say they need to update their documents to Florida and why?
I recommend, we have a number of clients that come from, out of state and they have existing documents. We typically recommend that all the supportive documents, which consist primarily the durable power of attorney, be Florida based, because a lot of the financial institutions aren't familiar with out-of-state documents and they will not accept them.
Yep.
So we recommend that as soon as you get to Florida, get yourself settled, you meet with an estate planning or an elder law attorney and get the durable power of attorney and the other supportive documents updated.
Right. And the durable power of attorney in other states, I just dealt with this with my grandmother, was just a few pages. Here in Florida, it's what, 13, 14 pages?
Actually, ours is 35.
Wow. Okay. So quadruple that. Now, if people are trying to protect their assets, what would you say? that they need to look at? What type of documents do they need to look at if they're trying to protect their assets for their heirs?
Okay, so let's take a look at what the average cost of long-term care in a skilled nursing facility is between $8,000 and $12,000 per month.
Mm-hmm.
And I think the statistics show that 60% of us over the age of 65
Mm-hmm.
will enter a skilled nursing facility despite the best intention of loved ones. Sometimes our family members just can't assist or help out.
Right.
Because of work, family, or disability.
Mm-hmm.
So we're really left with only 4 ways to pay for our long-term care: private pay, long-term care insurance, government assistance, and VA pension.
Mm-hmm.
There are 3 hurdles: assets, income, and then the actual application needs to be submitted. From an asset standpoint, there are exempt assets and non-exempt assets. Some exempt assets are primary residence, which is it can be valued at $603,000 or less. But if you sell that, that's money that's not exempt.
Mm-hmm.
A vehicle, life insurance exempt. But if you have non-exempt assets, if you have more than $2,000 and you're applying for government assistance, you're not going to be eligible.
Right.
So from that perspective, we have to be looking at different ways to transfer our assets from a proactive standpoint. And there is something known as the look back period and the penalty period
Mm-hmm.
that we have to be cognizant of in the transferring of assets.
Absolutely. You certainly do, because that can mess up your application for quite some time if you make a mistake.
Yeah.
So gifting your money is not a good idea, right, Brian?
Not to an individual.
Right. All right. Mark, are you with us yet? You've got yourself on mute this time, though. Try taking yourself off. And Danielle, while we're waiting, talk to us about what a certified financial planner is. What does that mean exactly?
Well, as a certified financial planner, you are, as a financial planner, you're taking fiduciary responsibility when you're working with your clients, which is in the best interest of the client. And really what a financial planner should be helping their clients do, or helping you when you contact a financial planner, is to define where you are today and define where your goals are for the future.
Mm-hmm.
Someone comes in and they are, either thinking about retirement or at that retirement age, we always want to, educate them on the hurdles, some of the situations that could happen during retirement, and, making sure that they don't run out of money before they pass on. We don't know a time when they are going to pass, but we can assure them by setting up their assets and helping them with their assets and their goals to make good decisions, especially in the first years of retirement. And we always ask them how they plan on funding their long-term healthcare needs. So either through day-to-day or at the end of retirement when they're looking into what their wishes are for long-term care, because as the attorney said, most people are going to be faced with that decision of needing help.
Yeah, they definitely will. Even if it's for a short-term
Yes.
rehabilitation stay, I think we all can attest that we know most people have ended up in a skilled situation. Now, you hit the nail on the head when we're talking about long-term care. What kind of long-term care insurance policies are out there? What exactly is long-term care insurance, and how can it benefit you?
Well, there are a few different types of long-term care insurance now. It used to be where there was just a traditional method of long-term care insurance, which is very similar to a health insurance policy. You pay a premium for it. You pay those premiums until you should need those benefits. And if you pass on, before needing those benefits, you don't get anything for that value. So it's just like a traditional type of health insurance, which you look at purchasing those type of policies as young as possible so you can get into the lower rates. But it is something that those premiums can raise as you get deeper into retirement. We have found that most clients are moving away from that traditional long-term care type of policy and going into more of the hybrid policies. There is something similar to like pre-funding your long-term care, where you can put some money aside, let's say 50,000, 100,000, and depending on your age and your health of when you purchase it, can get you 3 to 6 times as much. It's kind of like, saving for college. When a child is born and you do prepaid college, that's 18 years until they're going to go into college. So you're paying for long-term care at today's prices. There's 2 types of those type of policies. There's a receipt driven and then an indemnity type of policy. The indemnity policy is that you do not have to show receipts. You qualify for it by your doctor, saying that you can't perform the, 2 out of the 5 daily living requirements to get qualified. And then once you qualify, once you've gone through the elimination period, which is either, most of the time these policies are 90-day elimination policies. So once you go through those 90 days, then you just start getting a check in the mail. Clients love that, knowing that they're not going to have to submit a receipt. And because they may have an adult child or a niece or a neighbor, or they may need like a gradual type of care, so they can do their own shopping. People just really like that. They can also use these policies if they are outside the country, which is a nice benefit. There's also a type of hybrid one where if you don't use the benefits up, they can get transferred to a spouse, or they can get transferred to an heir if there's no spouse involved. So it's kind of like they're getting something. So if they don't use it, there's still a life insurance tax-free benefit to their heir. So they don't feel so bad about having to put this money aside.
Yeah.
And obviously self-funding, but self-funding is very expensive. And that's when we bring in an attorney into the case, and we talk about ways to strategize to make sure that, we're making sure that every dollar is being counted for on those client wishes, whether giving away to charity, giving it to heirs, and they understand if they are going to go that self-funded, exactly what could happen and what the process is of happening as they spend down those dollars.
Yeah, for sure. Absolutely. All right. Thank you, Danielle. Mark?
Hello.
He's with
Can you
us.
hear me?
Yes.
Okay.
Yes.
Terribly sorry about the technical difficulties. My apologies. Didn't get a chance to introduce myself. My name is Mark Ary. I'm with Trust Mortgage, and I am a senior loan originator and a reverse mortgage specialist.
Okay, perfect. And just roll right in, because we're talking about ways to pay for care. And reverse mortgages. First, talk to us about what they are. Debunk the theory of them being bad. What made them bad back in the day, and we'll kind of go into ways that you can pay for different long-term care alternatives.
Absolutely. Great question, too. The reverse mortgages, and more commonly known as a HECM, which is a home equity conversion mortgage, they have basically transformed over the last 20 years due to the direction of HUD and FHA. A HECM, a home equity conversion mortgage, is an FHA product, and it is backed by HUD. And it is, in the last, like I said, 20 years, basically FHA has rewritten most of the rules on how a HECM works. And they put in a whole bunch of wonderful mechanisms that can be used and utilized by borrowers to help pay for some of the things that we've already been talking about, or the panelists have been talking about, as far as long-term care, maybe healthcare policy, long-term healthcare policy, and those types of things. There's also ways to use it for retirement, for accumulation of wealth, to go ahead and pull that money as a way to have a pool that can be used by your financial advisor or whomever you have helping you with your money. And that's another thing too. It's not always good for everybody, and it certainly needs to be analyzed and reviewed to make sure that it is a good fit for that person that plans on using it.
Yeah, and I think it's important to note a couple of things with reverse mortgages. You can use them to downsize. You can use them to go into a continuing care retirement community like Cypress Cove. There's a number of different things that a reverse mortgage can be used for, including like aging in place in your own home. Just to kind of debunk that theory of reverse mortgages being a bad thing, I like to kind of travel back in time because we're so used to paying our mortgage, and that includes your HOA, your taxes, and those miscellaneous fees. When you come into a reverse mortgage, you no longer have a mortgage payment, right?
That is correct.
You still have to make those payments. And I think that they've really come a long way in the counseling process. So do you want to talk to us about the new type of counseling process and how you would qualify for a reverse mortgage if it's right for you?
Absolutely. So there are some basic requirements. You need to be at least 62 years or older. You need to be the owner of your primary residence. And so again, there's so many variables to when you can go into and how all the different ways you can use a reverse mortgage. That's not a simple question to kind of answer. And usually part of that counseling is something that I would have that conversation with the borrowers and potentially their family as well, preferred actually, to kind of get everybody involved. And you would go over all the possible scenarios that you could use the reverse mortgage for. And then once you make the determination that if they are qualified and it is something that would work for them, one of the additional things that FHA has put in place is a requirement for independent third-party reverse mortgage counseling, which is very, very beneficial to the borrower. And they can ask any question that they may have that they don't know if they're 100% comfortable with, or if they're wondering if they're getting a straight answer. So that is just one of the many things that they've done. In addition to that, FHA has put in additional thresholds to make sure that the borrower isn't going to get into a situation where they can't afford to, because even though it does eliminate the principal and interest payment of your mortgage, you still have to pay your property tax and insurance. And that can be something that can be pulled out of the reverse mortgage as well, that you can set up in advance. They didn't have that feature in the past. That was something that they had added. And they also have created a mechanism to where you can set up like an equity line based right off of the reverse mortgage that can accumulate wealth that can be used to pay for any of those types of things moving forward. And then having said that, you also mentioned long-term health care. So lots of times you'll have a husband and wife, a spousal situation where one or the other is deteriorating to a point where they do need some kind of care, and it's unfortunate, but a reverse mortgage can be used for the cost and to offset some of those expenses to have one of the spouses go into that type of care facility. So it really, really is very versatile. And I think it's a really cool product. I really like it.
I think Danielle would even say you can use it for investing, and she can help with that.
Danielle and I work together quite a bit, and she is one of the financial advisors that I recommend our clients to go to once they get to a point where we determine that it can be used.
Sure.
Again, it's super important to get with somebody who can help you plan out the long-term expenses on a month-to-month, an annual, and a long-term basis.
Absolutely. Absolutely. All right, Gerry, I'm going to loop back around to you. Now, we've talked about what a continuing care retirement community is. And we in the industry have so many different acronyms, and it's very confusing. But talk to us about the different type of contracts, because that's really important when people are looking at these retirement communities. You have an A, B, C, B modified. There's so many different things. So talk to us about what those different type of acronyms mean.
Correct. There's typically 3 different contracts, A, B, and C. The A contract is the traditional life care, life plan, life care contract itself. That one covers you with unlimited assisted living, skilled nursing, memory care, and you don't pay for those higher levels of care because you've now paid an entrance fee, which can be refundable or not, depending on, how much you want to invest in the entrance fee. And then that would cover you with these higher levels of care. So your monthly would stay the same as if they're in the apartment or villa forever, even if it's a couple, and one might be in assisted living, one might be in independent, or maybe one's in skilled, one's in independent. It doesn't matter, or both in healthcare. The monthly would stay the same as if they're both in that apartment or villa forever. So it is like long-term care insurance. So that covers them, so they never pay for those higher levels of care. The B contract is kind of the middle of the road. It covers them with unlimited assisted living, memory care, which is considered assisted living. And with us, we also cover them at Cypress Cove for 30 days of skilled nursing. So it's a lower entrance fee and monthly service fee coming in because they're giving up that unlimited skilled nursing portion of it. But it too can be refundable or non-refundable after a period of time. So that's kind of the middle of the road B. And then we also have a C contract, which is considered a fee for service. So that would be someone that wants to move into Cypress Cove or another life plan community, and they want to know they have a plan in place if something happens, where they're going, who's taking care of them, and how much they're going to be paying for it, but they're willing to pay for their own higher levels of care. So they may have long-term care insurance or feel they're self-insured. So they will pay for their own. They may never go to a higher level of care, but if they do, they're willing to pay for that. And that one can be 100% refundable. Typically is always 100% refundable, but there's still an entrance fee, but they can actually go directly to that where we're holding it and use that to spend down for their higher levels of care. So that's a little something different that we started several years ago, which really makes a lot of sense for folks.
It does. That's interesting, Gerry. I'm glad I asked you that because I'm not sure other C-type communities do that. I'll have to investigate. Thank you.
Yes.
Now, it's interesting you bring that up because I've always compared a C contract and said, like, what's the difference between a C contract and a typical rental community that you go to? There are so many out there in the community. So tell me what the difference between a continuing care retirement community and a rental is.
Well, this gives you the plan. So you're guaranteed placement if you do need a higher level of care. Many of the rental communities may have assisted living or memory care, and may likely not have, skilled nursing. It may be full. You may have to move to another community. And especially if you're a spouse, or even if you're single and you have all your friends here, that's not a time that you want to be moving off campus to another community. So this way you're insured of where you're going, who's taking care of you, and you know exactly what you're going to be paying for it. So that's the main difference between us. Plus there's the tax advantages as well that you get in a life plan community that you don't have in rental communities as well.
No, that's fantastic, Gerry. I think that there's so many opportunities at a continuing care retirement community. And I always say my dogs are not going to take care of me when I get older. So I need to look into a continuing care retirement community and definitely meet with Danielle and talk about, planning for aging, because the sooner you start, the better, right?
Correct.
All right,
It's
Brian.
never too late. We don't want to look back, but the sooner you start is the more options you're going to be able to have.
No, you're absolutely right about that, for sure. Now, Brian, I've heard of several different types of trusts that are out there in the world. Talk to me about the different kinds of trusts and how they might be able to help you avoid probate.
Okay, so basically there are a few classifications of trust. It's going to be revocable, irrevocable, testamentary, or living. A revocable trust, I want you to think about that old-fashioned piggy bank where you used to take a hammer and you'd smack it to open it up, and then they got real fancy and they put a cork in the bottom of it. And so if you wanted to take your money out, you'd pull the cork out, right? So if we think of that piggy bank as a revocable living trust, that piggy bank has a set of instructions inside as to who's in charge, how the assets get distributed upon passing. So the person who creates this trust is known as the grantor or settler. And you know what? In a revocable living trust, they control that cork. They're the one that's in charge. They've named the beneficiaries to where the assets go. And when it's freely can be modified, it can be amended, it can be changed, it can be revoked. Now, the benefit of that revocable living trust is it avoids probate. Upon passing away, the assets get distributed outright. The irrevocable trust is very similar, except for it's that piggy bank, but you don't control the cork. A third party controls the cork. And but that too avoids probate.
It can be confusing, just like the CCRCs with the different types that are out there. Now, what's the difference between an estate planning attorney and an elder law attorney?
Okay, so elder law is defined by, an elder law attorney is defined by their client, the client that's being served. So the lawyer who practices elder law may handle a range of issues, but has a specific type of client, a senior. I typically take a holistic approach where we handle a variety of different issues. So it's estate planning issues and counseling clients about planning for incapacity with alternative decision-making documents. We would also assist the client in planning for possible long-term care needs, including a nursing home care. We're locating the appropriate type of care and coordinating private and public resources to finance the cost of care, and working to ensure that the client's right to quality care are all part of an elder law practice. Some of the following would be the preservation and transfer of assets, seeking to avoid spousal impoverishment when a spouse enters a nursing home, dealing with Medicaid, dealing with Social Security and disability claims, disability planning, including the durable power of attorney and living trusts, financial management, healthcare surrogate forms and such, guardianship, general estate planning, probate, and the administration and management of trusts. That's all, but it's all defined by the client who's a senior.
Okay, thank you. That's a perfect explanation. I appreciate that. All right, Danielle, I'm going to move back down to you. Now, if somebody already has long-term care insurance, do you have any advice for them? That's one question. And then I also want you to go into the bad word of annuity, because it's just like reverse mortgages. I think the annuity scares people. They don't understand it. They don't know what it means. So if you can kind of dive into those two questions, if you already have long-term care insurance, I know you have some advice on that. And then what is an annuity today's annuity?
Well, I do deal with a lot of clients that already have long-term care insurance when they come and meet with me. And the first thing, I ask them is if they understand how their policy works. And I would say 9 times out of 10, they really don't have a clue of how their policy works. They've either forgotten it or it's been so long since they've purchased it that they don't have a annual call with the advisor that sold them that policy, or their policy has changed and they've gotten maybe some letters in the mail that they really didn't understand. So I tell them to bring everything that they have, their policy. We get on the phone with the carrier and I help them understand. And I make sure that I'm asking questions to kind of gear the conversation to make sure that I understand the policy. And then we are making sure that they understand it. So when they leave my office, even if they're not a client and they're just coming in for a consultation, I want to make sure that they understand what they currently have. Because I have seen some situations where they've either forgotten that they have a policy in place, and so they haven't been using the benefits that they could have used, and they just don't understand how to start receiving those benefits. So if they get the knowledge, like when they're healthy and they understand it, then they're going to be able to trigger a using of that policy much more easier. Now, annuities. Annuities have changed a lot through the years. And yes, annuities have gotten kind of a bad rap, but the word annuity just means a guaranteed income stream, cash flow. And, you know, as the annuitant or the owner, they can choose what type of cash flow they want to insure. Annuities are owned by their contracts that are owned by insurance agencies, insurance products. So you're really ensuring the ability for some type of a cash flow. So there's different types of annuities. And a lot of times I'll see clients that have these old annuities too, and they don't really totally understand. And annuities are kind of like cars. You know, if you went back 20 years ago, an automobile wouldn't have maybe all the features that it has now. Now, that doesn't mean that people need all the features that they have in cars today, but it's good to have those options. And so we look at the policies, especially the older policies, and first we educate, find out what they have, and then see if there's something better. When you're shopping for an annuity or when you are purchasing an annuity, you need to have a plan and a reason why to buy that annuity. Annuities are not good for everybody, but they do help clients sleep at night knowing that they won't run out of their money.
Right.
So, you know, depending on your situation, an annuity is a perfect solution for them. And other times, annuities aren't so perfect. So it's really about understanding what your goals are and making sure that you are going into a product that's going to achieve that goal.
Right. Definitely. And I think it's a good way to plan for, like you said, if you know you need a certain amount of money each month, it's a good way to plan for having that come in.
Right.
So people living on Social Security and they have this little bit of money that they need to transform in some way, shape, or form, that would be a good candidate.
Well, annuities have become very, very popular now that, you know, companies aren't giving out pensions.
Right.
So an annuity can be a self-made pension for oneself. So you know that you're not going to run out of money, and it's going to be a guarantee of an income flow for the rest of your life.
Yeah, definitely. All right, Mark, we're going to move it back on over to you. I did have the question that a lot of people, I think, are curious about, and maybe it's changed from the past, but if somebody passes away, what happens to the house? What happens to the debt? And how does that work?
Another very good question. A lot of people are under the impression, and this is one of those debunked reverse mortgage theories, that once you enter into a reverse mortgage, that the house is signed over to the lender. That couldn't be further from the truth. It's basically like a regular mortgage, what they would call a forward mortgage, as opposed to a reverse mortgage, where you have some kind of lien on the property. When you look at an amortization schedule, without even adding in the annual appreciation of the property itself, it really takes about 20 plus years to, if you were really aggressive and you tried really hard to spend all the money and all the equity that was in the home, that would take you probably about 20 years. So, and the nice thing about that is it's a contract. So it's kind of like an annuity. Once you enter that contract, you never have to pay principal and interest regardless of what happens to the value of the property, whether it increases or there's some kind of crash like we had in 7, 8, 9. So that is one of the benefits. And people talk about the insurance cost, which FHA charges on all FHA mortgages, doesn't matter if it's a forward or reverse mortgage. That upfront mortgage insurance premium actually covers any losses that would be incurred by the lender. So the borrower never has to worry about any kind of situation. And ideally, they would live to be, way, way longer, kind of like an annuity. If I bought an annuity for $100,000 and I lived long enough to where I received more than $100,000 in payoff, well, now it's a great benefit, right? And the same thing reverse mortgages in that regard. Ideally, you'd want to have the borrower to outlive that. If they didn't, whatever equity is left in the home, that passes on to the heirs, just as it would any kind of regular lien on a property. So that's covered. And I would mention something too that's kind of following up on Danielle Gates's comments. The reverse mortgage also has a feature among, like I said, the many, many features. It has an annuity type feature where you could actually have the reverse mortgage pay you $500, $1,000. Now, of course, that depends on the value of the home, how much equity in the home. There's a lot of factors for that, but that is an available option as well.
Right. And that could just help you pay your regular bills, your water bill, your electric bill, food. Also, now is such a good time to investigate looking into any kind of, reverse mortgage, refinance, things of that nature. So talk to us about the interest rates and what you're seeing in the market right now.
Sure. Well, interest rates are very, very low for reverse mortgages. Since it is an FHA program, it is backed by FHA, and so that's a subsidized rate. So right there, you get a much lower interest rate than you would for a traditional mortgage, like a conventional Fannie or Freddie type mortgage. So you have that advantage right off the get-go. There are two types of reverse mortgages. You can get an adjustable rate mortgage or a fixed, just like you can on a regular mortgage. The adjustable rate mortgage allows with a lot more features. And the reason why is because it has that open-endedness that you never really kind of know the value of the property or how much debt is going to be incurred. And that's typically by the longevity of the borrower. So that adjustable rate mortgage actually has the much lower mortgage rate, and it comes with that equity line feature that allows the additional equity in the home to grow at the same rate as the note on the mortgage. Now, if you think about that, I mean, that's a pretty cool feature in itself, where if my interest rate, which I think right now is, when I just locked one last week, it was like 2.73 as an adjustable rate. It had over $150,000 that went into the equity line feature, and that equity line will grow and compound at that same 2.73% rate that the note will and has. So, I mean, it's pretty spectacular in that sense. So it's not something that is a mortgage of last resort. That's also was kind of the common theme of the reverse mortgage. Now, and it's very well accepted by FINRA, which is the government or the organization that governs financial advisors and money managers. It's a product that is a great way to accumulate wealth while you're still working and be part of the financial plan that you would have with your financial advisor like Danielle.
That's perfect. All right. Well, thank you for that wonderful explanation. I actually learned a little bit more about everything that each of you do, which is the purpose of all of these. So I want to thank everybody for coming to SBB University Day. We appreciate it. If you have questions, please put them in the chat. I just want to thank all of our panelists for joining us today.